What's going on, everybody? In this video I have a lot to go over, so we're going to get started right up on it. I'm going to look at a couple different Bitcoin mining stocks on the chart, give you my thoughts on Bitcoin, and I'm going to feature a clip showing that we don't exactly have to get to the 2% target to start seeing Fed rate cuts. And as Jerome Powell has said a million times before, the effects of rate hikes are yet to be felt. There's definitely a lag there, and incoming data will continue to indicate that inflation is coming down. But I definitely want to show you this clip, so let's get started on that.
Importantly, the more investors can take really significantly higher rates off the table, and even now maybe higher for longer off the table, that has meaningful implications for the rest of the credit markets.
Now, you said that it's justified by the data. Walk me through that for a moment, because we did just get data that showed that inflation was decelerating.
Right.
But not maybe as much as the market was anticipating. So is the coast really clear here?
Not necessarily clear, but I think actually your correspondent elicited one of the most interesting responses from Jay Powell, and that he said that you don't have to be at 2% in order to start easing. And that's one of the things we've been talking about internally too, because if they were to leave policy rates static and inflation does continue moving lower, which it has been, then the real rate would be increasingly more and more restrictive. So they've opened up the path to easing while not quite being at target, because they're acknowledging that if they were to stay static, they would be getting more and more restrictive.
It's so interesting to me because one of the many knocks on the Fed has been that it tends to be behind the curve habitually.
Right.
So the fact that Jay Powell said that, does it say that we're in a different kind of Fed regime? Has the Fed learned its lesson on that front?
Well, history will answer that question. But I think what it's showing is the Fed is not on a one-track policy mind, and they are being more flexible. I mean, think about the responses that they've had to deal with over the last couple of years, even going back to March, where they had unorthodox responses to a mini banking crisis here in the US and around the globe. So they've really had to be flexible with their policy, not just think about the policy rate. One thing that didn't come up today was the balance sheet. That the expectation, I guess, is that we would still continue to see that roll off in the background. So they're using the various tools that they have at their disposal, and I think they're showing that they're flexible and data dependent. So they really mean it when they're data dependent.
And Steve, what's Guggenheim's view of when those rate cuts could start next year?
So we were pretty early on thinking that the Fed would pivot. We've been thinking that they would lower rates upwards of 6 to 7 times, meaning 150 to 175 basis points next year. That's still our general belief, but it's conditional on how the economy goes. I think one of the things that the Fed's been worried about over the before the end of October, was how much tighter financial conditions we're getting. They weren't able to say that publicly, but when you saw interest rates go from 4% to 5% so quickly, I think it caused them to react. And importantly, the economy's slowing down. They're starting to see signs of a weaker labor market, which they want to a certain extent. They want it in the extent that it actually lowers inflation and wage inflation, but they don't really want a much higher unemployment rate. They would like to engineer what they're looking for, which is a soft landing.
And so, but if you're looking for 150 to 175 next year alone, and they're saying 75, that's a big gap.
Yeah.
Does it imply that we do get a soft landing and so that they feel like they can? Or does it imply there's a recession and they feel like they need to?
We're seeing a higher than normal risk of a recession, which would then be met with higher than expected rate cuts. If the Fed is able to engineer this softer landing, then we would expect a more measured approach to easing policy. So it's a highly conditional answer, but one that, importantly, and we're bond investors, it's been a tough couple of years for bonds in general. You have really elevated money market balances. You have investors who are looking to come back into bonds, but we're not at an all clear sign necessarily in the aggregate, but the confidence is there to get back into the asset class when you stop thinking about higher and higher interest rates.
So I will leave that full clip down below for you. It's about 5 minutes, but basically what he's trying to say is the Fed is trying to get to that soft landing, and they won't get there if they keep these rates at record highs all the way to 2% inflation, all the way to a CPI that's 2%. And for that reason, he's expecting more rate cuts than what the Fed's projecting, pretty much double. If we keep these rates high into 2% inflation, then it's much more likely that we get into a recession. And because of the last FOMC, all these small caps are definitely rallying. The Fed's talking about rate cuts now. And the fact that Jerome Powell is even talking about lowering rates before the 2% target, that's very big, and the market definitely reacted to that. But I'll try to go into a little more detail on what I got out of that video clip, and I'll put it down in my Discord. It's free to join. But for the rest of the video, I'm going to look at some of the miners, and small caps across the board are having definitely a nice little recovery day. And I'm sure some of you have noticed that I haven't been talking about the charge points, the BNGOs, the Cynthionics of the world. And honestly, I've just been avoiding them because they have such an ugly chart. And while everyone's responsible for their own actions, you know, when I talk about those, there's always a chance that just because I'm talking about them, people want to buy. And I'd rather start talking about these when the charts look better, when they look more promising. And trust me, I'm no large YouTuber by any means, but still, I'd rather talk about these stocks that I do believe in still when we get towards better charts. A lot of these riskier, small cap, unprofitable companies have been in horrible downtrends with these record high interest rates, and I do expect them to recover as we get to those rate cuts, which improves a lot of those small caps that would otherwise have to dilute shareholders or take out extremely high interest rate debt. But there's a little update on all the small caps I used to talk about. But let's look at these miners and what's going on there. First off, CleanSpark, we just created new yearly highs, and it's always great to see a stock continuing to create new highs. That's very bullish. We recently saw a golden cross, that's also very bullish. But keep in mind that CleanSpark is overbought on the chart, so tread carefully. But overall, I do expect CleanSpark to continue to appreciate in price. And I do think a great way to go with this is $20 2024 January, maybe February calls, covered calls. I personally think it's pretty unlikely that CleanSpark's going to roughly double in price, and these $20 strike covered calls give pretty good premium for a pretty low risk of selling your shares. And in reality, you know, if in this short period of time, if by January or February of 2024 CleanSpark gets to $20, I would assume it would be very overbought on the chart and probably wouldn't be a bad time to lock in some profits. But my overall goal for those covered calls is for them not to hit the strike and to just collect that easy passive income. So remember, as things get rolling, as things get hot, you sometimes got to step back and just look at what's going on. You know, is it very likely that we're going to double in price in a month or two? I'd say it's pretty unlikely. And when we get to these overbought territories, I think it's a great strategy to sell covered calls. Just like when we have a sell-off and we become oversold, I think it's a great way to get into some cash secured puts to potentially buy CleanSpark for a lower price than it's at. But CleanSpark's still looking great. We're creating new highs, which is extremely bullish for that stock. And I know I'm getting ahead of myself, but next earnings, they're expecting a record-breaking quarter where revenue is concerned, and I do expect we might see profitability before the halving, but that still remains to be seen. Next up is Sphere3D. This isn't as bullish on the chart, but we have been seeing a nice resurgence, a nice gain in price lately. This only bottomed out about 2 weeks ago, so keep that in mind. And as I said recently on Sphere3D, you know, what I'm watching for is a break over the 200 MA and to stay above it for a somewhat sustainable amount of time. Last time we broke above it, it only stayed over the 200 MA for a few days, and we never saw that golden cross. We never saw the 50 and 200 MA cross. They've basically been like two magnets in the opposite direction, pushing away at each other the whole time. That's the only way I can explain it. Every time we get close to seeing that cross, they just start forcing away from each other. But I do suspect soon we will see that golden cross and we will see a huge surge in price on Sphere3D. But I don't yet have shares. I'm still being patient. I'm still keeping an eye on it. That could bite me in the future and I might miss out on some huge runs here. But I'm trying to be patient for a more bullish chart. One thing to look out for Sphere3D is a break above 180. Then potentially we can come and test that 200 MA. And I'll leave my last Sphere3D video at the end screen for you if you want to look a little bit more into what's going on there. I did go over their mining update. Next up, I want to talk about Terawolf. This has been on a pretty steady, very, slow and steady rise since November. It just looks like it's been a bit less volatile than some other Bitcoin miners out there. And one thing that's very encouraging here is we are trading above both the 50 and the 200 MA. Keep an eye on this ascending trend line. If we break this, we may see some pain. And also keep an eye on these moving averages. It does look like they're starting to curl upwards, indicating that we're going to see some more positive momentum. We're starting to see increasing volume on an increasing price, which is fantastic. And throughout the last couple of earnings, we have seen some nice appreciation in revenue. Looking year over year, they're posting like a $5 million, $3 million, $4 million quarter, and now they're approaching 20 million in revenue. And as they continue to increase their hash rate, as Bitcoin goes up in price, they are going to continue to see record-breaking quarters where revenue is concerned, and hopefully soon they'll turn a profit. Now, I did want to end this video with Bitfarms. It's been going absolutely parabolic, huge increase in volume, just saw a golden cross. We're definitely quite a bit overbought on the RSI, and the last couple of times we got to an RSI like this, we did see a pretty dramatic sell-off. So on a break of this trend line, I would be looking to get into some Bitfarms. I think it would be a great opportunity if we see a little pullback, if we see that RSI reset. The chart here is definitely looking a lot more bullish. However, I want to see that RSI cool down for a good entry point. Now, one thing I see as a negative here compared to other Bitcoin miners like CleanSpark, for example, is they didn't see a record-breaking quarter in their last revenue, which a lot of the Bitcoin miners have been seeing. And their big highest revenue quarter was actually in March 2022, kind of towards the middle part of the bear market. And because we're not up there yet, again, back at those record-breaking quarters for revenue, similar to CleanSpark, to me that indicates that they probably didn't aggressively grow as much during the bear market, selling off their Bitcoin. But that's okay. I do believe they'll still get to record-breaking quarters, just not the upcoming quarter. It may take another 2 to 3 quarters before we get to that record-breaking revenue, before we start getting towards 100 million in revenue. It does look like their quarterly losses have been tightening up a bit. And as we start seeing those big runs on Bitcoin, that increase in revenue, I do expect Bitfarms is going to be one that actually sees a profitable quarter at some point in possibly 2024, maybe 2025. I do think Bitfarms is another one to keep an eye on, and I'm going to be watching for it for an entry point if we do pull back a bit. But let me know what you guys are thinking about this week. It's definitely been a nice couple of days now that the Fed meeting's out of the way, now that we seem to have kind of a dovish Fed talking about rate cuts. And if they want to see their soft landing, I agree, we're going to have to see those rate cuts before we get to that 2% target, which overall will help these small cap stocks, Bitcoin miners, and the overall economy. But let me know what you guys think. What miners are you getting into right now? Which ones are you watching? And let me know what cryptos you guys are watching. I think now is a great time to start looking at some cryptos, start talking about some of the altcoins that have been running. Let me know what you guys think about that. Thanks as always for watching, guys, and I'll catch you later.